Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today, we are going to talk about YCBD. We're focusing our analysis on CBDMD Inc., a stock that just a few weeks ago, in early December of 2025, it delivered one of the most volatile and frankly perplexing price actions I've seen all year for a microcap. The sheer force of the trading suggests something fundamental shifted, but the mechanics suggest something else entirely.
Oh, the numbers demand attention. I mean, we're talking about YCBD trading in a staggering range. What was it? 79 cents to $1.43 on December 11th alone. That's an 80% intraday volatility spike. But the real story is the volume. 103.27 million shares traded in a single session.
And let's put that number in perspective because it's just wild. The average daily volume for YCBD was around, 453,000 shares? So we saw a volume increase of 22,600%. I mean, that alone signals a massive market event. The stock went from total obscurity to the center of speculative attention, almost overnight.
And the context of that volume against the public float is, it's essential for understanding the chaos. The public float, the actual tradable supply, is extremely low, only about 8.29 million shares. So in that one session, the entire tradable supply changed hands about 12.4 times.
Right. And that massive turnover is precisely where our disagreement begins. I view this spectacular price movement as a justifiable and honestly a long overdue unwinding of a huge distress discount. I think this was driven by the company achieving fundamental financial stabilization and most critically, regaining regulatory compliance. That opened the door.
I'm just not convinced by that line of reasoning because the movement itself is the story here. While the compliance news was, absolutely the trigger, the price action that followed feels like a non-fundamental structural anomaly. The data suggests this was a highly technical event, a liquidity squeeze run by algorithms and momentum traders, totally decoupled from the actual intrinsic value of CBDMD.
I see why you think that, but let me give you a different perspective. My position is that this volatility, this chaos, it confirms the success of some extremely aggressive financial engineering. It was aimed squarely at removing existential risk. When a company eliminates the threat of delisting, it fundamentally changes the asset for investors who, couldn't touch it before.
Okay, that sounds good, but what's the hard evidence that existential risk was truly removed beyond just the day-to-day market noise?
The hard evidence arrived on December 5th, 2025, the formal notification that YCBD had regained full compliance with NYSE American listing standards. They had resolved deficiencies related to Section 1003A, AI, and II. And in plain English, those deficiencies are about low shareholders' equity and unsustainable net losses, the very things that were threatening their listing.
Right, the dreaded .BC designation. The public mark of imminent delisting was removed on December 8th. We agree that was the catalyst.
And the compliance was supported by genuine structural improvements. Preliminary results for Q4 showed they reduced their net loss by a remarkable 46%. It dropped from $3.7 million down to about $2 million. This validates their whole profitability pivot strategy and shows real fiscal discipline. They actually achieved stabilization.
I'll concede the stabilization part, but let's talk about the mechanism the market used to reprice this safe asset. The fact that the entire float rotated 12.4 times is, to me, prima facie evidence that this surge was driven by high-frequency trading algorithms and short-term day traders exploiting scarcity. This was not irrational repricing by long-term holders.
But are you just discounting all the intentional work the company did on its capital structure? Beyond profitability, they eliminated the Series A dividend obligation. That saves them $4 million annually in cash. And furthermore, the recent $1.7 million Series B capital raise set a clear $1 conversion floor. These are material, stabilizing improvements.
They are absolutely material to survival, I agree. But the speed and the ferocity of the movement, it suggests a forced technical trade, not some measured accumulation based on those savings. The price reflected what I'd call a liquidity vacuum. You have this massive demand hitting an extremely small supply pool. Market makers, forced to cover shorts to meet these relentless buy orders, they had to chase the price higher, and that just fueled a vertical feedback loop. We saw the purest expression of this with the 55% surge in after-hours trading on December 12th.
That's an interesting point. I would just frame it differently. You're sort of arguing the volume was just random retail FOMO, but I believe professional money was simply reacting to a risk profile that had dramatically improved.
I'm sorry, I just don't buy that it was purely reactive. The dark pool forensics strongly suggest informed positioning occurred long before that news ever hit the public. This rally, it feels engineered.
Okay, explain what you mean, informed positioning. How does that tie into all this?
You have to look back to November 26th, 2025. On that day, total volume was almost 10 million shares. That's 20 times the average. And yet, the vast majority of that volume happened off-exchange, in the dark pools. This is where large institutions transact away from the public eye. And crucially, the short volume ratio reported that day was 54.45%.
That's a massive spike, sure, but what does it prove?
It proves preparation. A 54% short volume ratio on massive off-exchange volume, it strongly implies that large entities were using internalizers to accumulate a massive long position while strategically using short sales to suppress the price. They were priming the stock before the public compliance news was released. The mechanics of the off-exchange trading, that explains the movement we saw. The fundamentals only explain the trigger they were waiting for. And look, let's shift focus back to the history that enabled this structural chaos. You're championing the success of their financial engineering, but that success came at an astronomical cost to legacy shareholders. I mean, the cumulative 1-for-360 reverse stock split ratio over just 2 years. Think about that. An investor who bought 1,000 shares in 2023 now holds 2.7 shares. How can we possibly define this as a successful recovery when they've effectively wiped out their investors?
I acknowledge the severity of the dilution. It was brutal, no question. Arguably necessary, but brutal. But for the investor in December 2025, that history is, strategically speaking, irrelevant. We have to reframe that legacy dilution as the critical prerequisite for what we just saw.
How can you just ignore shareholder devastation like that?
Because the history of those splits, it effectively locked up or entirely wiped out the legacy supply by slashing the share count from hundreds of millions down to just under 9 million. The dilution created the necessary ultra-low float. In financial terms, this float restriction is what made the stock so sensitive to news. The dilution was the necessary evil that created the highly volatile, responsive, tradable asset we're analyzing today. It created scarcity where none existed. And that brings us back to the mechanics. You rely heavily on this idea that dark pool activity implies some kinds of manipulation or a forced squeeze. But let's look at the settlement data right before the rally. We saw a total collapse of fails to deliver FTDs to negligible levels by mid-November.
And why is that important to your argument?
Well, FTDs are failed settlement obligations, often associated with aggressive, naked short selling. The collapse of FTDs in mid-November signaled the system was fine. The rally was not a forced buy-in of trapped naked shorts, which completely contradicts the classic retail short squeeze narrative, especially since the official short interest is only, 1.62% of the float. It wasn't a squeeze. Demand simply overwhelmed the available supply once the risk was gone.
That's a compelling argument. But have you considered the timing? The FTD data is, well, it's largely irrelevant here because the strategic positioning happened before the compliance news was official, and it happened off-exchange.
I'm not convinced. FTDs track all failed obligations, regardless of where the trade originated.
But the November 26 dark pool anomaly, with that massive 54% short volume ratio, strongly implies that large institutions use those internalizers to accumulate without disrupting the public exchange and without generating FTDs. They weren't trapped shorts being forced to buy.
They were long-side momentum players who were already prepared. It was a managed, premeditated technical event, leveraging the low flow created by that terrible dilution history.
So your argument just fundamentally dismisses the operational recovery entirely, because regardless of the mechanics, the company is strategically leaner and it's performing better than its peers. The Q4 results show a critical return to sequential net sales growth, up 3 to 5%. They've successfully cut cash burn dramatically. I mean, this focus on survival and efficiency is the definition of a successful turnaround.
I fully agree that the internal cost discipline is commendable. They fixed their balance sheet, they fixed their NYC compliance issues. But sustainability isn't just about internal cuts, it's about the market they operate in. And we have to talk about the significant external operational risk that makes any long-term valuation questionable right now. The looming regulatory cliff from the 2025 hemp crackdown.
Okay, which specific threat are you worried about?
Legislation is moving fast in Congress to ban intoxicating hemp-derived products, specifically Delta-8 and certain Delta-9 THC analogs. YCBD, like many in this space, has expanded heavily into these verticals because they offer much better margins and higher growth than traditional CBD.
And if that legislation passes?
If it passes, it would effectively decapitate a critical revenue stream. The financial stabilization you're championing becomes temporary unless this industry-wide existential risk is resolved. So, while the company brilliantly managed to fix the NYSE delisting risk, they are now facing a potential federal regulatory risk that is arguably far more devastating to the business model.
That is a fair and a material point. The regulatory environment is without question the greatest external liability. However, by achieving NYSE compliance and demonstrating fiscal responsibility, the company has bought itself time and legitimacy. They can lobby, they can pivot, they can retool because they are solvent and listed, which they were not 6 months ago. The compliance allows them to fight the regulatory battle from a position of relative strength.
That is a strategic improvement, certainly. But my point is that the current valuation, which surged over 80% in one day, is built on a technical momentum trade, a low-float squeeze that completely disregards the cumulative 1 for 360 dilution and the fact that a huge part of their growth engine could be legislated out of existence next quarter.
So, to summarize my perspective, YCBD successfully navigated an immediate financial minefield. The solvency and delisting risk is gone, and the sharp price increase represents, to me, a rational repricing of that newly restored safety. The company is structurally healthier, and that is what the market correctly recognized.
And my conclusion remains that the structure is key here. The surge is a high-risk momentum trade built on exploiting the ultra-low liquidity created by all that historical dilution. It was driven by algorithms chasing a compliance trigger, and it completely ignores both the shareholder devastation and the massive unresolved regulatory threats still facing the core business.
It seems we both agree that the company is structurally healthier, but we fundamentally diverge on whether the current valuation reflects that underlying health or if it is purely a function of market mechanics driven by that now tiny float. The listener is left to weigh the value of compliance and internal improvements against the harsh reality of market structure and external business risk.
Indeed. There's certainly more to explore as this trade settles and we await the next set of results.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.